Hi, welcome to Wise Beyond Bitcoin, your home for the crypto neo news, education, and opportunities. My name is Ryan.
My name is Lucas. And as you know, we also love to give you not just the crypto neo, but the macro updates as it relates to the economy at large and blockchain and crypto. So without further ado, let's take a look at the latest and greatest. We've been, of course, following the Fed and following the connection between what's going on in traditional finance with the crypto markets for quite some time. And the narrative that we're going to explain kind of goes in line with what we've been talking about and sharing for quite some time if you've been following this with us. And that is, it's all about expectations, managing expectations. And if people see something happen that they expect to happen, then you see good results. And if something happens they don't expect, then often it's met with more negative results. In this case, what's happened and why is it so great?
The Fed just released their decision for what they're going to do with rates, and just as we expected, they're going to do is what they've been saying. They're going to raise rates by 0.75% of a so that's what people expected, 0.75%. That is in response to some historic data on inflation that came out just a few weeks ago. We're seeing the 41-year high in terms of changes in the CPI, in the inflation measurements. And so there was some fear that the Fed could raise rates even higher than 0.75, that it could be a whole percent. And so that's one of the things that market does not want. That would be seen as a very overt and aggressive change in policy. And so they got what they wanted. Like you say, the Fed is really, it's almost as important the way they speak about what they're doing and what they're going to do, and the way they kind of create an expectation for the future. That's as important as what they ultimately decide to do in terms of where the rate should be at, because that decision on its own is powerful, but it's kind of how they manage the way we respond to it, the way traders and the way the market responds to it is almost more.
They can price it in, like you said, they can kind of price in those expectations. Exactly. So if they say we may have to raise interest rates 50 basis points next quarter, and then next quarter comes around and they have to say, oh, we have to do 75 basis points. Well, then people are going to be freaking out. You might see a huge sell off but if they say, hey, we might be looking at 75 basis points or higher, and then they come out with 75 basis points because it's what was expected, or it could have been higher and it wasn't. Now you see it being met with, okay, things are moving along the way we think. The economy is still strong and handling these rate hikes just fine. So,
and the Fed's, the big thing is the Fed's not nervous. They don't feel their backs against the wall. They feel like they can continue with their plan, right? Their plan is working, and they don't see a need to deviate fundamentally from it. It's when you start to see these sudden changes in policy that you think, well, what are they seeing that we're not seeing, right? And you start getting panic. So that's obviously the market liked what happened today. 1:30, the news broke, and shortly there, 1:30 Central, 2:30 for the Eastern, I believe. And so you see clearly the markets rallied to that. We had just seen some news come out recently for earnings. Google and Walmart, I believe, did pretty decent. Not Walmart, Google and some tech stocks did well. I want to say Walmart's was weak, so there was some choppiness there. The Fed does mention in their brief today that the economy is slowing a bit, right? Even though unemployment still remains strong, consumer spending and the cost of business for the cost of borrowing and some of the costs for business are starting to contract, right? So we're seeing some production and consumption spending slowdowns, and so but they're keeping an eye on that. And what they're really wanting to say is that expect more rate hikes even as the economy softens. Like, that's part of the plan.
And we've been saying this. We've been covering this. Not we've been saying it. We've just been reading the tea leaves. They've been saying it. We've been reporting it. And in fact, we'll continue to follow this. But they've been talking about the rate hikes over a year ago, and we've been mentioning this. And if you're aware of this, then you don't go all in and say, well, let me put everything in blockchain and crypto or in tech stocks or in the market in general. Because if you're aware that the Fed is trying to slow the economy down and manage expectations this way, then it's good to kind of sit on the sidelines and let the air come out a little bit. And I bring this up because while this is good news, because the markets are rallying, and of course we see that strong correlation with the traditional market. You're seeing that over in crypto as well. But the idea is that it's still, we're not saying that spring is next week. We're still in the middle of winter, and their plan is to continue to slow the economy down. Their plan is to continue to raise rates. So while this might be a good response in the market in the short run,
we're not done.
we're not done. So,
and we're starting to see data from the market on where traders expect that reversal point to be. And right now the thinking is that sometime in the middle of 2023, next year, there will be a reversal. The Fed might start cutting rates there. And the thinking is that the Fed funds rate will get to be near 3.5 or 4% next year when that happens. So that gives us some understanding of what the market thinks is likely. But to your point, we do have some time to go before we get there.
But the good news is what they're doing has been working in the best that they, well, as much as they would like to see it working. They're continuing with their plan. They haven't had to avert the plan and move on to something else.
Right.
And something else that we've been mentioning, and we'll continue to mention, I know you've got an article about it, but fighting inflation isn't only done through the Fed. There are other ways to help bring prices down. In fact, the Fed is limited in what it can do with interest rates. And
well, let's talk about that, because inflation is the rise in prices, the rise in price of most things, right, in the economy. And one of the ways that can happen is when there's too much money chasing too few goods and services. But the other way that can happen is there's not enough goods and services to go around, given the demand that there is, right? And on the pandemics, this economic shutdown, then there was supply chain and logistics problems because of the lack of labor, and because of pandemic related issues. We're still dealing with that now. And then not to mention the disruption in supply chains that was driven by the tariffs that were created prior to the pandemic. So there's all these supply side shocks that are working all in the direction of higher prices. And when the Fed slows the economy down, that's not going to solve that supply side issue. And if anything, it's going to make it worse, because it makes it more expensive to borrow money to higher factors of production to produce more supply. So you could actually see the supply shock increase as we slow the economy down. So to your point, we should be not trying to throw this whole inflation problem in the lap of the Fed. They have one tool, and it's not suited to deal with it without a lot of pain, without dragging the economy into a recession. So if we could throw other, all hands on deck, right? And we'll get into that on the next article. But it deals with tariffs, cutting tariffs, letting trade happen, but before we jump into that, I just wanted to highlight on this article that the Fed is allowing its balance sheet to shrink by around 47 billion a month, and that's about to double in September. So when that happens, that could I'm waiting to see if that has any liquidity effects in credit markets, in borrowing and lending and borrowing, in the kind of overnight credit that firms make use of to meet their bills. You're looking at like the commercial paper markets, and some of these short-term credit markets could be affected first, and by that loss of liquidity. So I'm just curious how that works out. It'll be interesting to see if something like that triggers a response from the Fed. Because liquidity crises, those happen. That's how 2007. That's how the housing bubble collapsed in 2007. It first showed up as a lack of liquidity in these credit markets, and so that's something the Fed watches closely. And I'm just curious to see, if there's a response or if things just continue on when that pace of of the bond of
Well,
their
as you
balance sheet.
learn,
Increases.
I know that you'll be posting about it and sharing with others the more we
Yeah.
learn about it.
Now, before we get into the article about Biden and tariffs, I just wanted to mention that Powell did give a hint, because we mentioned expectations are so important. Now they're letting the expectation get out there that there could be an even larger rate increase, and it's all data dependent. And this is at the next meeting. This will be for the following month, but this is all data dependent on what happens between here and there. I imagine in terms of inflation data, as well as GDP. We're going to get GDP data later on this month, and so seeing if the economy is really contracting quickly, all that will probably go into this decision. But it's a change. It's definitely a change in tone to hear that they're even considering larger than 75 basis point rate hikes. So that's something to take note of.
And it's not surprising when you look at kind of when you read the tea leaves, when they say that the economy's softening, but the labor markets are still strong. And we've talked about this in videos before. That's why I mentioned this again. If you've been following our macro updates, we'll continue to share that economic linguistics, that language programming that's used. But when they say the labor markets are strong, what that means is we still have room to fight this. If they say the labor markets are weak, then that means we need to slow down and be careful. We've talked about that in the past, where good news can be bad news and bad news can be good news.
And how important labor markets are in this calculus, right?
And so them saying that a full a full point or more could be on the table, I wouldn't be surprised, especially if we're talking about starting to cut back as soon as early next year, 2023 sometime.
They got some ground to cover, right?
Right, some drastic move up in the short run is almost necessary to achieve that quick return to
what 2% inflation, right?
I hope you enjoyed our little update of the latest Fed announcement. Of course, we've been following the Fed for a while. We'll continue to follow the Fed in the macro market economic updates and how that parlays over into the blockchain and crypto market. And yes, I think we also have some more information to share, not just the Fed at work.
All right. Yeah, we're going to talk about Biden, the tariff policy that came from Trump and his decision whether or not to keep it, and what that means for inflation. So look out for that.
Until the next time, have a beautiful day and namaste, y'all.